Welcome to Central Bank Central. I'm Kathleen Hayes. So it's the countdown, just days away, the Federal Reserve's last meeting of 2025. What will they do? Well, everyone's watching data closely, even though data's a bit scarcer since the government shutdown. A very important number out today as the Federal Reserve looks at what they see as labor market weakness, a reason to go ahead and cut the key rate one more time. We've got a weekly number that is closely watched. Importantly, right now, because the data keep coming in on new claims for unemployment benefits, jobless claims. And guess what? Those claims that were already at a relatively low 218,000 fell to 191,000 in the latest week. So what are we to make of this? What will the Fed make of it? Well, I'm very happy to bring back to Central Bank Central Komal Sri-Kumar. Sri is the founder and president of Sri-Kumar Global Strategies, someone who has been following the Fed, the markets, and trying to translate it all for his clients for many, many years now. So, Sri, here we are, jobless claims so closely watched, a big drop now, 218 to 191,000. What do you have to say?
It's a very clear situation, Kathleen, to me. There is no doubt in my mind that the labor market is relatively robust. Today is even stronger than I had anticipated. But the fact that the initial jobless claims came out at the lowest level since September of 2022 says to me that it is in no need of monetary stimulus. That's the first part. The second part is there is expectation that many of the tariffs that the Trump administration has introduced may either all of them or many of them may get canceled due to a Supreme Court judgment based upon the initial results. And if that happens, the tariffs are also going to be gone, and we are also going to have one more big impediment of what is affecting the employment picture. The last point I would make here, Kathleen, is there are monetary factors, and as Milton Friedman said, inflation is a monetary phenomenon. On the other hand, employment reacts to other factors like tariffs, expectations of the people who own businesses. And because you lower the interest rate by a quarter point or a half a point, they're not going to increase work hiring phenomenally as a result of that. So you have these issues, and what the administration and the Fed are trying to do is to correct a structural problem by monetary means, and that doesn't work.
Well, that's a nice summing up of what the Fed is doing and making it clear structural factors that rate cuts aren't going to help. And I think a lot of people have raised that question. Okay, so jobs are weaker because of all these things that have been going on, and so why cut rates? Well, let's take this step by step, starting with some of the economic data. 'Cause that in itself has been an issue because it was, we didn't get hardly anything during the shutdown. A lot of alternative data is getting a lot more focus now. So, in terms of what we've seen in the recent data, um, what what would you say about let's contrast this. People are looking a lot more at the ADP, the private jobs data. That's very well done. That's a great team there. It's a different series because it's private sector jobs, no government jobs. But their latest numbers showed a net loss. I was just at an event yesterday where I was speaking to an economist who covers this very closely, and this person was quite focused on the fact that the jobs data, when you look at the ADP, have been so weak. In fact, the latest number, I believe, was actually in negative territory. So, how do you respond to that?
Uh, we have had this is a history. The ADP numbers have quite often not corresponded to what you get on the non-farm payroll that comes from the Bureau of Labor Statistics. So this is not the first time that you have this. And my expectation is that I can't explain why it is that the ADP numbers often get changed when you look at the non-farm payroll. But the non-farm payroll number, Kathleen, the latest one for September is up 119,000 jobs. So the government numbers are not suggesting to me any weakness at all, one after the other. And today's initial jobless claims is another data point here. So I would say even the ADP has shown previously that jobs were created on a week to week basis in a new series that they introduced. So my guess is this is a number which is just off, somewhat off kilter in terms of where they are. And if you look at the monthly ADP numbers, they go down and then they go up. And you can't make a decision simply based on one single data point that they show you.
Well, that's a good point there. And in fact, I'm just going to quickly point to some recent data we've gotten. Uh, Retail sales last week, pretty solid. People still spending money. There's a lot of focus on the lower 50% of people who maybe are much more hit by inflation, and their spending is tougher to do versus people who are more affluent, etc. But still, there's spending going on, no doubt about it. Um, Auto sales, of course, were steeply weaker in the fourth quarter compared to the third quarter. Delta Airlines reported losing what $200 million in bookings. So you get all these different numbers. Um, how much weight do you put in on, I should say, the latest kinds of numbers we're getting? And what does it say to you? Is this a mixed economy? Is this something the Fed needs to be cautious about or not?
I think there is an explanation for the retail sales remaining strong and at the same time the lower income people having difficulty purchasing. How do you put them both together? There has clearly been a shift in income distribution from the lower and middle income groups to the higher income groups. If you look at the so-called Gini coefficient, whenever the Fed intervenes, it disrupts the situation. With the Ben Bernanke 2008 quantitative easing start after the Lehman Brothers bankruptcy, what you had was a deterioration in the Gini coefficient. In other words, there was more income distributed from the lower income group to the higher income groups because interest rates that you could earn on your bank deposit was close to zero, and you as a lower income person could not afford to go into the stock market. So the people who invested in the stock market did very well. So the income distribution worsened. And look at when that situation changed. Do you know when? After COVID. 2020, when there were huge fiscal stimulus measures that were given and benefit payments paid, that is when the income distribution improved and the Gini coefficient showed income distribution actually becoming more egalitarian. So it is again deteriorating, and we will find that 2 years from now that that is happening. So why do I say all this? All this means is inflation is much more of an issue than we have acknowledged. Lower income groups are suffering more from it. The higher income groups, they don't care because it is more than made up by stock market gains. So when that is the fact, my point has been that the central bank should focus only on one mandate, inflation. And to look at inflation and employment, you not only cloud up the situation, you muddy up your own objectives and you don't achieve anything properly.
Well, that's certainly that's something that the Federal Reserve, the group who wants to cut rates now, seems to be putting to one side because they will acknowledge that yes, inflation is high, although many of them expect it will come down. And in the meantime, they say they don't want to risk the doves that people want to cut because there's another strong segment that isn't for cutting right now. But for that group, that their reason is that they don't want to risk hurting the labor market. So again, people talk about data, data dependent Fed. Is the Fed being, focused on the right data? How do you look at this? Because let's make it clear, you are not for rate cuts right now.
I'm not for rate cuts right now at all. And the reason why the Fed wants to cut rates, and now we are talking about a 90% probability of a rate cut next Wednesday. The reason that is happening is because this Fed is a data independent Fed. They
Data
do
independent, you said.
exactly. They do what they want, data be damned. It doesn't matter what the data show you. And that is exactly what happened. 2020, I wrote in my weekly pieces that Jerome Powell is wrong and inflation is not going to be transitory. Why? Because there was a huge increase in fiscal spending, interest rates were lowered to close to zero, and the balance sheet of the Federal Reserve, already bloated after the Lehman Brothers fiasco, between 2008 and the beginning of 2020, it had quadrupled. And then again, we increased it from $4 trillion to close to $9 trillion between 2020 and 2022. That was to me a signal that inflation was going to be persistent. A central bank chairman talking about it and calling it transitory is not going to make it that way. So the issue here is, once again, this inflation is not going to be transitory. And you asked about what to do about employment. Leave it to the Treasury, leave it to the fiscal side to worry about employment. Let monetary policy focus only on inflation.
Well, it's interesting. I was at an event yesterday where there was there were a number of speakers, and I think one of the themes that came up from more than one in various contexts was specifically that the Fed really needs to have one key mandate, and that is price stability.
Exactly.
And that's this is kind of I think this is a debate now that's more to the fore. Because for a long time you didn't have it wasn't quite so complicated. Inflation went up and the Fed would hike rates, and if the economy looked weak, it would cut. And now there's this more of a sense that we can't do that. We can't risk that. Do you think there's any why do you think it has shifted? And do you think it has anything to do with whether it's conscious or even kind of unconscious that the Fed has had a lot of pressure on it to cut rates from the White House, and that to a certain extent, there's enough justification when people look at some of these jobs data, like the ADP, to say, oh, look, it's slowed down. So that's the risk. Let's go ahead and do at least one more rate cut this year.
Uh, but that is not what the Fed has done. They have done two, and they are going to do one more next Wednesday. So rather than cut once, they cut four times in the last half portion of 2024, and particularly in anticipation of the political of November 2024 presidential elections. So that takes me, Kathleen, to say that one, the Fed is not cutting just once and seeing, let's see what happens to the ADP numbers if we cut once. They'll be cutting next Wednesday for the seventh time in about 14 months. And what are they going to achieve out of it? It's not clear to me that they are going to offset the impact of tariffs on employment. And if that is the case, the only other impact that those cuts are going to have will be on inflation. And I am really scared about 2026 and what the inflationary consequences of the Fed policy would be. So we have already heard Jerome Powell call inflation transitory. He may simply make one other statement. I have decided those things simply don't make sense anymore. Stick to the fundamentals.
So, is there anything else? Let's get we started out, one of the factors you're watching very closely is tariffs, right? Tariffs, a structural factor that, as you point out, may be making a lot of businesses one more reason to sit back and see what happens next rather than hire workers. So, so where is that now? What do you think is going to happen next? Because there is this question about whether or not some judge is going to say, hey, no, you couldn't do that, President Trump. You can't do it this way. If you want tariffs, you have to follow these rules, these laws. So what's the latest there, and where do you think that's heading?
There are two or three consequences I can see. Let's assume for a second that the Supreme Court decides against the president and the tariffs. If that, because the initial discussions they have had, they showed skepticism about the government's arguments. And if they stick with it and they actually do not let the tariffs stay, the president and his team, they are going to try to replace it with some other sectoral tariffs. They are not going to give up and walk away from it. They'll try to find a replacement. So the impact on the market is going to be further uncertainty. You do not know what the ultimate landing is going to be for tariffs. If the president is able to find some way of getting it done, some loophole that will be acceptable to the Supreme Court. So during that period, if I were running a firm and I have employees and I'm thinking about whether to expand or not, I'm not going to expand. I'm going to sit still. And today's initial jobless claims, Kathleen, supports my expectation. What's happening here? I am not going to lay off workers either because I may not be able to get them back. So at this time, the initial jobless claims are low because I'm not letting go of them so easily, but I'm not hiring either. And that is
Right.
a happy situation for the economy.
Right. So if you were Fed chair, what would you be communicating to the public right now? I guess we know you just said that we don't, the labor market's holding in, inflation is high, and you think it may very well go higher. And I guess you'd be saying, you know, um, sorry guys, we got to wait and see, something like that.
If I were, I mean, this is never going to be done by the Fed. So this is my wish list, and I will tell you, and it will probably be between you, me, and the watchers, but nobody else is going to do anything about it. And that is, as a student of John Taylor's for my PhD and one of my professors for the PhD dissertation, I am a strong believer in rules, like a Taylor rule, and then let your interest rate move. And in John's case, he had the employment being higher or lower than target, inflation being higher or lower than target. Those are the causal variables. And the dependent variable, as we say in regression analysis, is going to be what interest rate falls out of your calculation. Do something very clearly. There is no doubt for market players. They know exactly what the Fed is going to do because they can run the equation themselves. Why isn't that done? Fed is a bureaucracy. They perpetuate themselves, and all the voting members can go home. You can have a couple of computers there doing that work, put the equation in, come out of, let's see what comes out of it. And we don't need all of you to be employed and making speeches on TV and to the newspapers. But that's not what they are going to be deciding on. They want to be in the limelight. They want to move interest rates up and down and cause a furor in the markets. And that's what they are achieving. They are causing volatility. The Fed
Well,
goes from one financial crisis to the next financial crisis.
Well, sure, I appreciate what you have to say because there are a lot of people. In fact, at one of the events I've been at recently, some people were also complaining about, oh, they shouldn't talk so much. The Fed shouldn't talk so much. But at a time when there's so much division, at a time when there's pressure from the White House for the Fed to move toward cuts, I think it's important to hear from various members and certainly the Fed bank presidents who are among leaders right now, it seems, people who are not in favor of more rate cuts, who agree with you. Let's wait, the labor market is not as weak as you might think, etc. So that gets us to this question of who is going to be the next Fed chair, and that besides this meeting where they cut or they don't cut, and markets expect it, and you figure the markets are right. You don't like it, but they're right. Um, we're going to getting the next Fed chair announcement, and right now it looks like Trump has signaled kind of that he likes people who are loyal to him. Kevin Hassett, who is the head of the NEC and has been a longtime supporter of the president's and his policies, not just in this term, but the previous term, that he's probably the guy who's going to get the job. Now, we know Trump, he likes a surprise. Who knows who he's going to pull out of his hat at the last minute. But what do you think of him as the next Fed chair?
I think there is a lot of concern in the bond market about Kevin Hassett becoming the next chairman of the Federal Reserve. Again, rather than look at his past as an economist with different points of view, and not always correct. And remember, just at the eve of the day a dot-com bust, he was looking for the Dow Jones Industrial Average to increase by 2 or 3 times, and that was his forecast. And soon after he said it, the market collapsed. So we have all made mistakes. I wouldn't hold that against him. However, more recently, he has been completely towing the line of the president in terms of expectations. And he also knows the experience of what has happened between Steve Mnuchin and Jerome Powell in the first term. Mnuchin suggested Powell to Trump, who nominated him and was disappointed and was attacking his Treasury Secretary for having given the choice to him. Now, Scott Bessent, I think, is going to be in a similar unfortunate situation in 2026 because inflation is going to stay well above the 2% Fed target. Any reasonable Federal Reserve cannot keep on cutting interest rates under that situation. But the president cares only about cutting interest rates, and therefore, Kevin Hassett, assuming he's the next Fed chair, has two choices. Either he keeps cutting interest rates with or without the support of the entire board. You're going to have a very divided board in 2026. Even if he manages to cut interest rates, he's not going to be able to carry a consensus with him. So you're probably going to have a 2 or 3-way division at every meeting. That causes confusion and volatility in the market itself. Second, suppose on the other hand, he stands firm rather than toe the line of the president. And remember, 2026 is a midterm election year. And if he doesn't cut interest rates sufficiently before November, the president is not going to be happy. And you're going to see him attacking both Scott Bessent and Kevin Hassett, the next chairman, in public for not cutting rates enough. And the markets are going to be essentially roiled by this dispute between the two of them. So that's what I anticipate for 2026. And it's not going to be smooth sailing for Kevin Hassett at all, especially if Jerome Powell continues to stay on the board and does not leave in May, and he stays on the board and expresses his dissent, and like other governors, talks in public and disagrees with the new chairman, you're going to have a very interesting time in the bond market.
Oh boy. Well, of course, explain this to people because I think if you don't cover the Fed closely, you would think, well, wait a minute. Jay Powell's term is up, and I think it's the president's talking about saying who the next Fed chair will be, and then by the latest May, then his 4 years are up, right? But they don't, and people don't understand why this it's not a technicality. It's just the way the Fed is constructed. No Fed chair ever does this. They don't stay once their 4-year term is up. But people figure that Jay Powell can stay longer, and that's because of how the chair versus, how the FOMC is put together. Just a quick nutshell on why that can happen.
Here is the reason why that can happen. Look at the recent history. When the president started attacking Powell intensely, calling him all kinds of epithets every time, stupid, and the latest being a stubborn ox, which is the latest reference earlier in the week. Despite all that, Powell has stayed on in his job. And he told us famously, it is by law that I'm staying, and you simply cannot push me out. You cannot fire me from the job. And so, that being the case, I can't see him in May simply walking away completely from the Federal Reserve. Why not say, I'm supposed to be here until 2028 as the governor on the board, and the president cannot fire me, and I'm going to continue to stay. So in line with what he has done over the past year, it would suggest to me that he is probably going to stay on and be a thorn in the flesh in terms of expressing his decision as well as speaking in public. That is why I think it's more likely than not that you will have Jerome Powell to deal with for another 2.5 years.
Well, but also, even if Jerome Powell doesn't stay, if I'm was hoping maybe to get the job of Fed chair and I don't get it, and I'm on the board of governors, like Chris Waller, Mickey Bowman, others who have been in contention to maybe get the job. Hey, if I'm not going to get to be the chair, won't I feel that much more independent of the president? When I feel that much more ready to say, hey, if it's Kevin Hassett, hey, not voting with you, buddy. I'm not going to vote to cut rates again. I do think that's going to kind of free people up who are going to be at the Fed, who have these 14-year terms as on the board of governors. That in itself, even with or without Jay Powell, that whoever the new Fed chair is, they're going to maybe have a tougher time actually even getting anybody to vote with them. That would be very big. That almost never happens in history.
Exactly. That you summarized it very, very well, Kathleen. That's my expectation. The new chairman, whoever he or she may be, is not going to have an easy job putting it together. The consensus is not going to appear. And now that we have the precedent of board members speaking loudly and clearly, they go to all different corners of the world to make their pronouncements. John Williams was in Santiago, Chile, when he said we should be expecting a Fed rate cut in December. And others have spoken from other countries. And whenever they go, the press follows them and they want to make news. So if Powell is out of his job as chairman, I believe he will still continue to be speaking and he'll be a very frequently invited speaker because of his past. And he's going to explain himself and his disagreement with, again, assuming Kevin Hassett is the new chairman, his policies and the president's policies, he's going to tell you why he doesn't like them. And the markets are going to be confused as to where to believe. Now, the question is, Kathleen, what does it all mean to investors who are listening to your program?
Yes.
And this is something I've said, and I'm feeling my views are getting stronger and stronger by the week. I think the yield curve is going to steepen. They are going to cut short-term rates few more times with Powell and with the new chairman or chairwoman who may succeed him. And in that case, the short rate is going to go down and the 10-year and 30-year yield is going to go up. And Scott Bessent told us that what he really cares about is the 10-year yield, not the federal funds rate. If that's the case, he's not going to have his wish. The 10-year yield is going to go up. And today we found in Japan the 10-year bond yield went to the highest level since 2007. And you know what happened in 2007? It was the year before the Lehman Brothers crisis and the failure because it was sucking cash out of the United States and going out of the country. And if you repeat that in first half of 2026, it is not going to be a happy situation to watch as the capital is sucked out and Japanese yields going higher are one important factor in doing so.
Well, the Bank of Japan is very interesting, I guess, especially since the last election where when the new Prime Minister Takaichi was elected, and the BOJ meets, in fact, not next week, but the following week, and there seems to be more of a sense from their Governor Ueda that they might actually go ahead and do the rate hike that many have argued for, but didn't expect with a new prime minister who hasn't been a big fan of more tightening by the BOJ, although even she too seems now to be maybe more opening to that door. Just one more question, I guess, then, since you brought it up. How do you think that the two bond markets, do you think that investors that you advise, people are now following the Bank of Japan, the JGB, Japanese government bond market, way more closely than they have for some time?
I think that's absolutely right. I think seeing what has happened to Japan, and seeing what happened to yield curve control by the Bank of Japan, that it failed, and that the 10-year yield, which they thought would be, remember, not too long ago, the 10-year yield was close to zero. And now we are approaching 2%. And that is a massive movement in the 10-year yield because the yield curve control stopped. One of the other reasons that they are watching, and this was part of a write-up that I did a few weeks ago, is if the yield curve steepens in the United States and the 10-year and 30-year yield go up even as the federal funds rate goes down over the next several months, then there is going to be pressure by the Trump administration and Scott Bessent working more closely with the new chairman, assuming it's Kevin Hassett, and the two of them are going to work together to bring back yield curve control because they want to bring down the 10-year yield. And it is not a rare thing that it is not inexplicable that the last time we had yield curve control in the United States was 1942 to 1951, and we have not had that in almost 75 years. Why is that? The reason is the yield curve control in the United States was a dramatic failure. The expenditure for the Second World War and the Korean War, which put pressure on the Federal Reserve to keep buying treasuries, to keep the yield at a low level, simply did not pay off. And when the Fed got its independence in February of 1951 and went its own way, the yields shot up and people had massive losses. And that's why that is another danger to watch as you look forward.
Well, what an interesting time we we are in. What's that old saying about look out about living in interesting times? So, well, Shri, it's great to see you today. Thank you for taking the time. And uh, yeah, I'm just looking to, that's why it's so interesting. End of the year, Fed's meeting, last meeting of the year, and that there's so much, it seems that nothing is going to quiet down. Everything, at the very least, may be just even heating up again.
That is my expectation. I wish that were not the case, but I think heating up is what I expect for 2026.
Okay, well, all more reason to come back and see Sri-Kumar here on Central Bank Central. Komal Sri-Kumar is the founder and president of Sri-Kumar Global Strategies. Thanks again. And of course, I'm Kathleen Hayes, and this is Central Bank Central.